Forex Focus brought to you by IG, how inflation could help the US dollar. And of course, that seems so, oxymoronic that, well, how could, if I'm holding USD and inflation is high, and we have an inflation reading coming up here this week, the July core inflation is expected at 5%. Most recently it was at 5.3% that you can see here in the image. Frank, tell me how 5% inflation can be good for the US dollar. If I've got X amount of US dollars and inflation is 5%, that's telling me that all things equal, the price of goods and services in US dollars have jumped by 5%. And if I'm just holding that in cash, that's no good. Well, we're talking about US dollar here today relative to other currencies, which inflation has a little bit more nuanced of a relationship with here than just a straightforward inflation high, your currency relative to a basket of goods and services worth less. And you can see here we've been sticky at around 5 to 6% for the last 6 months. Inflation is off its highs from last year, but still expected at 5% where it's been and is more than the central bank wants it to be, which their target is 2%. You'll see, given the last year of price action, both in inflation and here in the euro US dollar, that there historically is a correlation between inflation and the inflation here in the US and US dollar appreciation. When we topped out at 6.3, 6.6, 6.3% in the fall of 2022, right around the same time as 20, 30-year lows in euro relative to dollar. And now bear with me, that means highs for the US dollar in this forex pair. And now as inflation has come off here in the US, you see the euro bounced back. The dollar gave up some ground after getting to those really historic price extremes at that time. So you can see, broadly speaking, higher inflation in the US has resulted in US dollar appreciation, historically speaking. But I want to highlight that relationship a little bit further because there is some nuance in there. High inflation can cause currency demand, but one currency only appreciates against another if interest rates are relatively higher. And this is all, theoretically speaking, though historically we've seen, some hard number correlations between higher interest rates in a given region and the currency being in greater demand, that currency appreciating, so to speak. And this starts to make sense, right? If I have high inflation here in the US central bank wants to raise rates high, the US currency is likely going to see some demand because people want to get that higher interest rate. So they're selling their Japanese yen at a 0% interest rate to buy US dollars at right now a 5% plus interest rate. But there's a little bit of nuance here. Now I'm roping in euro inflation because you might say, well, Frank, US inflation is still high. So why is the US dollar giving up so much ground against the euro? Well, here we have in red US inflation over the last year, and in green euro inflation. You can see euro inflation was 1 to 2 percentage points lower than US inflation in the fall of last year. And just really quickly, I'll bring back in that euro USD chart to show you, just keep your eyes on the first half of this graphic, that huge gap, US inflation so much higher than euro inflation, coinciding with those lows that we saw in euro versus US dollar. As euro inflation has come back to eclipse US inflation, the thought now being euro zone central bank, the European Central Bank, will maybe have to hike interest rates higher than the US because they now have higher inflation and now drawing some euro demand. People maybe now want to sell their US dollars, buy euros to invest at what could be a higher interest rate in the euro area in the future here. So what this flowchart actually looks like in terms of inflation and how it affects forex markets is high inflation. The central banks want to raise rates to lower that inflation, greater currency demand, but You only see that appreciation if that interest rate, that inflation, that whole ecosystem is higher than the pair partner that you're pitting it against. You actually might see depreciation, even if the US is seeing high inflation, hiking interest rates, but the Eurozone is maybe doing it at a faster pace, a higher clip there. The US dollar might depreciate against that currency. So relative inflation and relative interest rates really do lead forex historically speaking. It's not necessarily high inflation, high interest rates, currency appreciation. That relative piece is essential here. But this week's inflation number, a lot of people will be watching for its implication on all different markets. In the forex space, a higher than expected inflation number in the US could correlate to US dollar appreciation, with the idea that, oh, they're going to have to hike interest rates higher than expected. A lower number would, historically speaking, mean the opposite, could be correlated that way. Either way will be a really interesting number expected at 5%. Over 5% could lead to US dollar appreciation in some of these pairs. Under 5% could lead to depreciation, as the euro and the UK inflation has been in the recent past higher than US inflation. So those forex pairs, those major pairs, have been moving around with these inflation numbers. We'll watch to see what happens.